Companies have boards because without them, we would be left to the chaos of unchecked executive power. Imagine a world where the CEO could simply decide that all meetings must be held underwater to encourage deep thinking, or that all employees must wear neon jumpsuits for brand unity. Without a board to say, "Hold on a minute, Steve," the workplace would become a playground of whimsical yet catastrophic decisions. Boards serve as the wise, slightly grumpy grandparents of the corporate family. They're the ones who remind everyone to stay grounded, much like grandma reminding you to stop being a little shit, Timmy. Moreover, boards bring together a mix of experienced individuals who excel in the fine art of saying no in various creative ways. You usually have a finance guy to turn on budget requests, the legal guy to turn on almost everything else, and a seasoned industry veteran to say how everything is a bad idea. So where does this concept come from? Well, the concept of company boards can be tracked back to the early 17th century with the formation of joint stock companies, with one of the earliest and most notable examples being the Dutch East India Company, established in 1602, which was the first company to issue shares of stock to the public, and its governance structure included a board of directors known as the 17 Gentlemen, because the Dutch East India Company was always so gentlemanly. The idea of a governing body composed of directors gained traction as more companies sought to raise capital from multiple investors. This structure allows for the separation of ownership and management, providing a system of checks and balances. Because if you put a lot of money into something, you would also want some sort of control. In the 19th century, the concept of company boards became more formalized with the advent of modern corporate law. Legislation such as the British Joint Stock Companies Act of 1844 and subsequent acts in other countries codified the requirements for companies to have boards of directors. Today, boards are mostly seen in publicly traded companies, those whose shares are traded on stock exchanges, acting as the bridge between the shareholders and the company's executive team. The idea is that shareholders elect board members at the company's annual general meeting, with the aim of having a board with a wealth of experience and expertise from various fields, who then hold regular meetings to scrutinize reports and challenge the executive team's decisions to ensure alignment with the company's long-term goals. So where does it all go wrong? One of the criticisms of boards, especially in public companies, is that they can sometimes prioritize short-term gains over long-term sustainability. This is largely due to pressure from investors who are eager to see quick returns on their investments. As a result, boards may push for strategies that boost immediate profits at the expense of long-term growth and stability. For example, investors might push for aggressive cost-cutting measures, reducing research and development budgets, or laying off employees to boost short-term earnings. While these actions might lead to a quick uptick in the stock price in the short run, they can be detrimental to the company's future. Another potential problem happens when boards become too cozy with the company's management, leading to a lack of independent oversight. This happens when board members are not truly independent or are selected based on their personal relationships with the CEO rather than their ability to objectively oversee the company's operations, which can result in poor decision making and a lack of accountability, ultimately harming the company and its shareholders. Please leave a like and subscribe if you enjoyed, and let me know in the comments who your favorite company is.